Yes. So, guys, let's start with the new section now. Section 46. 46. Now, this section has two parts. 46 subsection 1 and 46 subsection 2. This section talks about company. So this section is applicable. 46 subsection 1 is applicable on the company and 46 subsection 2 is applicable on the shareholder. Okay. Now see, what happens that this company is in liquidation. So there is a company and the company is going for liquidation. Okay. Now let's take the example of X Limited. X Limited is a company and the company is under liquidation. Okay. Now at the time of liquidation, what happens? The company will close the business. Company will close the business. Okay, no? And one date will be announced that this is the date of liquidation. So a date of liquidation will be announced. Company is closing the business. At the time of closing the business, as on the date of liquidation, whatever outside liabilities are there, so they will be paid first because creditors are there, the lenders are there. Okay, no? So those outside liabilities will be paid first. So after making the payment of those outside liabilities, whatever remains, that is what? That is for the shareholder, for the owners. Yes or no? So you all are the shareholders. You all are the shareholders and the company is going for liquidation. Okay, some shareholder might be having 1,000 shares, some shareholder might be having 5,000 shares, some shareholder might be holding 500 shares. So different shareholders holding different number of shares. Okay. Now if your company is going for a liquidation, at the time of liquidation, whatever outside liabilities were there, all the outside liabilities are paid now. Now whatever remains with this company, assets, cash, etc., is now belonging to whom? Belonging to the owners. So you all are a shareholder. Now whatever remains after paying the outside liability, it remains for the owners only, no? So what this company will do? The company will give this cash, assets to the shareholders. So shareholders, we have paid all the outside liabilities. Okay, no? After paying the outside liabilities, what happens? This remaining cash, remaining assets belongs to you, will be given to you. Now is the company giving cash? Yes. Is the company giving assets? Yes. To whom? And this is given on liquidation. This is given on. Now don't you think that the ownership of the asset will change now? Ownership and possession of the assets will come in the hands of shareholder from the company. So earlier that asset was owned by company. It was in the possession of the company. On liquidation, if this is distributed to the shareholder, now who will become the owner? Shareholder. In whose possession the assets will be there? Shareholder. So ownership, possession of the asset changing, meaning the asset is transferred. And on this transfer, the company will be liable to pay tax because the company is transferring the asset. Yes or no? But don't you think the company should not be charged any amount of tax on this transfer? Or should the company be charged? Company is making the transfer, no? To the shareholder. So assets are transferred to the shareholder. Should this transaction be taxable in the hands of company? What do you think? According to you, should it be taxable? Why? Because if this transfer is made, it is made by the company in liquidation to its shareholder at the time of liquidation. Yes or no? And on this transfer, is the company earning any consideration from you? No. So since there is no consideration involved, yes or no, then why to charge tax on this transfer in the hands of that poor company? See, the company acquired the assets in 2007-8. When the asset was acquired? 2007-8. And the company acquired the asset for 1 lakh. Now today, it is 25-26. In 25-26, if that same asset is given to the shareholder, today the value of the asset was 20 lakh rupees. How much is the value? So for the period for which the company has held that asset, how much appreciation in the value of asset has taken place? 1 lakh to 20 lakh, 19 lakh value has appreciated. But that appreciation will be realized by the company if the company transfers and receives that 20 lakhs, no? Company is transferring. But is the company receiving that 20 lakhs from the shareholders? No. Company is not receiving any consideration on transfer of the asset. So this gain of 19 lakh is not realized in the hands of company. So why to charge tax on this gain on the company's hands, in the hands of company? This transfer is exempt as per section 46 subsection 1. So what this section says? That company in liquidation is transferring what? Is transferring cash or assets on liquidation to its shareholder. Now whenever this transfer is taking place, so the transfer of the assets by the company which is in liquidation to its shareholders, this transfer, my dear friends, this transfer is treated as what? Exempt transfer under section 46 subsection 1 in the hands of company. This transfer will not attract any capital gains in the hands of the company, because at the time of making this transfer, the company is not getting any consideration. Understood? If the consideration is not received, so whatever gain, whatever appreciation has happened up till now is not realized by the company at the time of making this transfer. So that appreciation gain should not be taxed in the hands of the company. Forget about this. Leave the company. Now, let's talk about the shareholder. Are you a shareholder? What are you receiving? Assets and cash. Yes or no? Whatever assets or whatever cash you are receiving, for that, will you give anything to the company? No. So they are coming free of cost. Yes or no? But don't you think whatever assets and cash which are coming to you will come to you only after you surrender your shares? Because now the company is under liquidation, and on liquidation you will have to first surrender your shares. Your shares will be cancelled, and whatever belongs to you will be given to you in the form of cash as well as assets. So first of all, tell me, 46.1 says, what 46.1 says? 46 subsection 1 says that transfer of any capital asset by the company in what? Liquidation to its shareholder. Okay, this transfer is treated as what? Exempt transfer. Therefore, no capital gain should be taxed. No capital gain should be taxed in the hands of company. Yes or no? This is your section 46.1. Now let's come to 46.2. And you have to understand this transaction properly. Now 46.2 says that shareholder, what did I say? Shareholder will also make some transfer at the time of liquidation. Shareholder will make the transfer, and for that transfer the shareholder will receive consideration. When liquidation will take place, the company will ask the shareholder, that shareholder, the company will no more be in existence. What are you going to do with these shares? surrender your shares. And whatever belongs to you will be given to you in the form of cash as well as assets. So are you a shareholder? Will you give back your shares? After taking your shares, what the company will do with these shares? Will make bonda? What the company will do with these shares? The company will cancel these shares. Shares ceases to exist. Extinguishment of right. Transfer by the shareholder. What are you transferring? Your shares. The moment you will surrender your shares, and those shares will be taken by the company, those shares will be cancelled, meaning that your right in a capital asset is extinguished. You have made a transfer. What transfer? Transfer of your shares. And for that, are you going to get any consideration? On liquidation, what are you getting? What are you getting? Banana bhaji. You are going to get cash. You are going to get assets. Okay, no? So are you transferring? What are you transferring, shareholder? Shares. For the transfer of shares, what are you getting? Cash. And you are getting assets. So that will be treated as your full value of consideration for transferring your shares, and based on that your capital gain should be calculated. This is what section 46(2) says. But remember, there is one section which I am going to teach you in income from other sources. When we are going to do dividends. Day after tomorrow only I will start with IFOS. In IFOS, the first point only is dividend. So there is a concept of deemed dividend. What? Interim dividend is there. Final dividend is there. That is your income. That is taxable. But sometimes, if the company gives you something in the form of asset, in the form of liability, or any distributions also done by the company at the time of liquidation, that distribution is also treated as your deemed dividend. Is the company making you any distribution on liquidation? Even that distribution is treated as your deemed dividend, but only to the extent of your accumulated profits as on the date of liquidation. So whatever reserves the company is having as on the date of liquidation, to that extent the distribution is already treated as your deemed dividend under the head IFOS. Now to that extent, the consideration will not be taxable under the head capital gains. So tell me, a shareholder is receiving what? Shareholder receiving cash also, and he is receiving assets also. Yes or no? From the company in liquidation. But for that, the shareholder will have to return the shares. Yes or no? Shares in the liquidating company. So the shareholder will give the shares. The shareholder will give the shares, and in return the shareholder is getting what? Cash and assets. So the shares which were acquired by the shareholder in 2011-12 for rupees 2 lakhs. These shares were acquired by you for rupees 2 lakhs, and you became the shareholder, and now this company is under liquidation. Now this company is giving you what? Cash. Because you are surrendering these shares, and against that you are getting cash as well as assets. So whenever you will give these shares, the shares will be surrendered. It is as good as transfer. So transfer of shares, against that you are going to get this as consideration. You are going to get this consideration. But out of this consideration, some consideration is already treated as your deemed dividend under section 222C under the head IFOS. So the amount which is already considered as your deemed dividend under the head IFOS, remove that amount. After removing that amount, whatever amount is coming to you now, that will be deemed to be the full value of consideration for transferring your shares. So for example, the company is giving you a cash of 5 lakh rupees. Cash of And assets given, the fair market value of the asset was, fair market value of the asset as on the date of distribution is 10 lakh rupees. So how much total distribution? This entire 15 lakhs will not be treated as your full value of consideration for the transfer of shares, because out of this 15 lakh, some amount is already treated as your deemed dividend under the head IFOS, under section 222C. So to that extent, you remove the amount, whatever balance amount is there will be treated as your full value of consideration. And based on that full value of consideration, you calculate the capital gain of the shares. And on that, you are supposed to pay tax. Shareholder, did you understand what is to be done? So you all are my shareholders. I'm going for liquidation. I'm going for liquidation. So on liquidation, on the company is distributing. The company is cash, assets. So any capital asset is distributed by the, to the, on liquidation. Yes or no? That transfer of capital asset, that transfer of capital asset on liquidation by this company to the shareholder will be an exempt transfer. In the hands of, will the capital gain be calculated? Will it be taxable? Sure. 46(1), this is an exempt transfer. 46(1), this is an exempt transfer. Done. The discussion about the company is done. Understood? Now tell me, are you a shareholder? On liquidation, the company will ask you, surrender your shares. So will you give back the shares? What the company will do with those shares? Cancel. If the shares are cancelled, shares ceases to exist. Meaning, your right in a capital asset will also extinguish. So the moment you will transfer your shares, the moment you will surrender your shares, the shares are cancelled. Now this is an extinguishment of right. This is an extinguishment of right, which is nothing but transfer. So shareholder, are you transferring your shares? Extinguishment, hello, are you transferring your shares? Against that, what are you getting? Cash 5 lakhs. Asset also you are getting, but what was the fair market value of this asset as on the date of distribution? 10 lakhs. So for transfer of your share, you are getting 15 lakhs, no? Based on this 15 lakh, you have to calculate your capital gain. Consider this amount as your full value of consideration. But wait. Out of this 15 lakhs, if some amount is already considered as your deemed dividend under section 222C, under section 222C, remove that amount. For example, under section 222C, under section 222C, 4 lakh was already considered as your deemed dividend. So out of 15, 4 lakh is already considered as your deemed dividend. Under the head, it is already taxed in your hands, no? Under the head, so you are getting 5 lakhs, you are getting 10 lakhs, total you are getting 15 lakhs. Out of that 15 lakhs, already 4 lakhs is considered as your deemed dividend under the head IFOS under section 222C. Remove that amount. After removing that amount, how much balance you are getting? That 11 lakh will be deemed to be the full value of consideration for transferring your shares. Based on this 11 lakh, you calculate your capital gain. Will you remember? 100%. Now, full value of consideration. Full value of 15 lakh, meaning total distribution. Meaning, minus, out of this, some amount is already considered as deemed dividend. Minus deemed dividend. Under section 222C, the balance amount is the full value of consideration. Minus transfer expense. In my example, did I take any transfer expense? No, nil. Net consideration, 11 lakh. Minus what? What are you transferring? So what is the cost of shares? 2 lakhs. The cost of acquisition of your shares. You reduce that. Okay, no? What amount will be there? 9 lakhs. That is your capital gain. Short term or long term? Depends that the shares are short term or long term. How will you know that the shares are short term or long term? You will have to check the period of holding. You will have to check the period of the shares. When did you acquire the shares? When did you acquire the shares? So this is the date on which the shares are acquired. From this date, the period of holding will start. And the period of holding will end on date of transfer, meaning date of surrender? No. Because date of surrender will always be after date of liquidation. And the moment the date of liquidation is announced, the company comes to an end as on that date. And usually you surrender your shares after the date of liquidation. So for example, if the date of liquidation announced, DOL, date of liquidation, it was announced 11th of August 2025. So once this date is announced, no, it is assumed as if the company ceases to exist as on this date. Bloody on this date, if the company comes to end, that means your shareholding should also come to end on this date only. Yes or no? But once this date of liquidation is gone, no, only then after this only the shares are surrendered. So when you will surrender the shares? After this date. So the date of surrender of the share, for example, you surrendered your shares on 19th of September 2025. When did you acquire the shares? Tell me. 11/12. When did you acquire the shares? So period of holding of the shares will start from 11/12. And you will say that, sir, I have surrendered my shares on what date? So I will take the period of holding till 19th September. Wrong. Buddy, how can you count the date? How can you count the period of holding after the date of liquidation? Because as on the date of liquidation, the company comes to an. So your shareholding should also come to an end on date of liquidation. Any period after the date of liquidation will not be treated as your period of holding. So your period of holding should end on date of liquidation for these type of shares. Yes or no? Understanding or not? So your period of holding will be from date of acquisition of the shares, which can be date of purchase if the shares are listed, and which can be date of allotment if the shares are unlisted. Yes or no? But it has to end on date of liquidation. Any period after the date of liquidation will not be counted as your period of holding of these shares. So your period of holding till here. So based on this period of holding, now you say that if the shares are short term, then the cost of acquisition you reduce and the balance gain is short term gain. Yes or no? But if based on this period of holding you come to know that the shares are long term, and in our case it is long term only. See, the period of holding is more than 12 months, period of holding is more than 24 months. Shares are listed, then more than 12 months. Shares are unlisted, then it is more than 24 months. Yes or no? So the resulting gain will be long-term gain. What is the cost? 2 lakhs. Will there be any indexation? Why? Because the date of transfer is nothing but date of liquidation. Yes or no? This date is on or after 23rd July 2024. So even if the shares are long term, indexation will not be available. Understood, everyone? So one small case. Okay, there is one company. Name of the company is A Limited. A Limited is going for liquidation. Okay, A Limited is going for liquidation. Okay, very good. Now, on 19th of December 2025. Now tell me, what is this date? This is the date of liquidation. Yes or no? And it has distributed cash rupees 5 lakhs and asset rupees 15 lakhs. This 15 lakh is the fair market value as on date of distribution, guys. No, here the asset is given on a particular date. On that date, what was the value of the asset? You are not going to see the fair market value of the asset on the date of liquidation, huh? You are going to see the fair market value of the asset as on the date of distribution. Yes or no? So, has distributed cash rupees 5 lakh and asset rupees 15 lakhs, which is the fair market value as on the date of distribution. And this distributed on what date? Example, it was distributed on 17th of January 2026. So distribution is happening on 17th January 2026. On that date of distribution, 2 lakh rupees cash is given and the asset whose value was 15 lakhs as on 17th January, that asset is also given. Yes or no? Distributed cash on this date to a shareholder, Mr. Girish. So Girish is a shareholder. Girish is getting 5 lakh rupees of cash and Girish is getting an asset whose fair market value as on date of distribution is 15 lakhs. Who held 1000 shares of the above company, which he acquired on 1/1/2009 at a cost of rupees 2 lakhs. Girish had acquired these shares on 1st January 2009 at a cost of rupees 2 lakhs. Yes or no? Which, see, read the question. A Limited is going for liquidation. On what date? 19 December 25. And it has distributed cash 5 lakhs and asset 15 lakh, whose fair market value 15 lakh as on 17 January to a shareholder, Mr. Girish, who held 1000 shares of the above company which he acquired on this date at this cost, okay, which he surrendered to the company, surrendered to A Limited on the said date of distribution. Okay. The accumulated profits, meaning reserves and surplus of this company as on of A Limited as on 19th December 2025, which is date of liquidation, was rupees 6 lakhs. Was rupees 6 lakhs. Discuss the tax treatment of above transactions. Discuss the tax treatment of the above transaction and show the workings. Did you understand the entire case? What happened? What is happening at what time? First, the company is going for liquidation. And After the liquidation, there is one more date. Date of distribution. On this date, the company is distributing what? Cash as well as asset. How much cash? 5 lakhs. How much assets? So this 15 lakhs is the fair market value of the asset as on date of liquidation, no? As on the date of distribution. Yes or no? So as on the date of distribution, the value of the asset was 15 lakh. This was given to the shareholder and also 5 lakh rupees. One more important information. Okay. Company has given an asset of 15 lakhs. 15 lakh is the fair market value of the asset as on the date of distribution, meaning on 17th of January. Now see, for this asset, one more important thing I am giving. The asset given on liquidation by A Limited to Mr. Girish was acquired by A Limited in 2006-7 for rupees 1 lakh only, for rupees 2 lakhs only. Let's say 2 lakh rupees. Understanding? So company purchased this asset in 2006-7 for how much? And now the value of the asset is 15 lakhs. That time the asset was given to the shareholder. How much is the appreciation in the value of the asset? So for the period for which the company is holding the asset, there is an appreciation in the value of asset by 13 lakhs. Should that appreciation be taxable in the hands of the company? Why? Because company is not earning that 15 lakh rupees as a consideration. So that 13 lakh rupees gain is not realized by the company. Hence that 13 lakh should not be taxable in the hands of company. Hence the transaction is an exempt transfer in the hands of company. So first tax effect. Should I dictate? Write down the solution. So in the solution, first, in the hands of A Limited. A Limited is company in liquidation. Yes or no? Transfer of asset acquired in 2006-7 for rupees 2 lakh to its shareholder Mr. Girish on liquidation. On 17 January 2026. 17 January 2026. Yes or no? Transfer of asset which was acquired in 6-7 for 2 lakhs to its shareholder Mr. Girish on liquidation. On date of distribution 17th of January 2026, when fair market value was 15 lakhs. Rupees 15 lakhs. Shall be treated as what? Exempt transfer under section 46(1) in the hands of A Limited. Therefore, no capital gain taxable in the hands of A Limited. Will you be able to write like this? Sure, sir, sure. In the hands of company, whatever discussion is there, it is only this much. Okay? Now we'll have a discussion in the hands of shareholder. Who is the shareholder? Mr. Girish, no? So now in the hands of Mr. Girish. Girish, in your hands, check your hands. In the hands of Mr. Girish, who is a shareholder. Okay, now? You tell me. You tell me. What is to be done here? First of all, we'll take total distribution. Total distribution on liquidation. Yes or no? So what is the distribution happening on liquidation? Cash value. That is rupees 5 lakhs. Yes or no? That is rupees 5 lakhs. And fair market value of asset as on date of distribution. That is rupees 15 lakhs. So total distribution is how much? 20 lakhs. Yes or no? Now out of this total distribution, some amount will already be taxed in the hands of Girish under the head IFOS as deemed dividend. How much amount will be taxable for him as a deemed dividend? Total distribution to the extent of reserves. What did I say? Total distribution to the extent of reserves as on the date of liquidation. As on the date of. So, somewhere it is given, no? So, how much was the accumulated profits of A Limited as on the date of liquidation? 19th of December 25 is the date of liquidation. As on this date, the company is having a reserves, meaning accumulated profits of 6 lakh. So, see, apply some logic. The company will pay dividend out of reserves. Company will pay dividend out of. So, how much was the reserves? Only that amount can be given as a dividend, no? So, total amount given is how much? 15 lakhs. Can the entire 15 lakhs be treated as dividend? No. Because that much reserves is only not available. How much reserves is available? 6 lakhs. So, out of the total distribution to the extent of 6 lakh only will be treated as deemed dividend. Understanding? So, under section 222C, out of 15 lakhs, out of 20 lakhs, how much will be treated as deemed dividend? 6 lakhs. Amount to the extent of accumulated profits as on the date of liquidation. Yes or no? So, what I will do? Less. What I will do? Less. Less what? Deemed dividend under section 222C. How much is that? Distribution to the extent of what? Accumulated profits as on date of liquidation. And what was the date of liquidation? 19th December. As on that date, what was the accumulated profits? 6 lakhs. So whatever distribution is happening to the extent of 6 lakh will be taxable under the head IFOS. 6 lakh. So I will take this amount to IFOS. How much is remaining? Girish, how much is remaining? 14 lakhs. Now this 14 lakhs will be treated as full value of consideration for transferring the shares. So this will be your full value of consideration for transfer of those 1000 shares. Transfer of those 1000 shares. How can you say that there is a transfer of shares? Because shares are surrendered. Shares are, that is, there is an extinguishment of right. So because of that extinguishment of right, I can say that shares are transferred. And for the transfer of those 1000 shares, Girish is receiving 14 lakhs. So that 14 lakhs should be treated as full value of consideration for transferring the shares. And based on this FVC, now the capital gain for shares will be calculated. Yes or no? So now out of FVC, what are you going to reduce? Transfer expenses, which will be dash. So what will be the net consideration? 14 lakh minus cost of acquisition of those 1000 shares. At what cost the 1000 shares were acquired? Tell me. The shareholder Mr. Girish, who held how many shares? 1000 shares of the above company, which he acquired on 1/1/2009 at a cost of rupees. So what was the cost of acquisition? 2 lakhs. So that 2 lakh will be reduced out of this 14 lakh. So how much is remaining? 12 lakh. This 12 lakh will be taxable capital gain. Which capital gain? Short term or long term? How come long term? You checked the period of holding of the shares. Now this will be a taxable long term capital gain. Okay. This will be taxable long term gain under section 112, because we are assuming that the shares are unlisted. Yes or no? Till the time they are not telling you anything about the shares, shares are always unlisted. And this long term gain cannot go to 112A, because under section 112A, STT paid gain is taxable. Yes or no? Is it an STT paid long term gain? No. So it cannot go to 112A, it will go to 112. But see, this will be taxable. This will be taxable in the hands of shareholder as per which section? As per section 46(2). This gain will be taxable in your hands. But this gain is long term, sir. Sir, this gain is long term. How did you come to know that this is a long term gain? Based on the period of holding. So period of holding will start from 1st January 2006. He acquired the shares, 2009. Okay, no? So 1st January 2009 to 17th of January 2026. But sir, this is the date on which the shares are surrendered. How can the period of holding be after the date of liquidation? So you are not supposed to take any period of holding after the date of liquidation. So you'll have to end your period of holding on date of liquidation. Yes or no? So are you going to take till 17th of January? No. So you have to take till date of liquidation. That was 19th of December 2025. Yes or no? Now based on this period of holding, we come to know that it was more than 24 months. Therefore, the asset is long term and the gain is long term gain. Easy or difficult? Made easy. Now pay attention. One step ahead. This much is done. 46(1) done, 46(2) done. Now my question is, now the shareholder, will have this asset. See, 46(2) capital gain, everything calculated. Now the shareholder will have 5 lakh rupees of cash and the asset whose market value was 15 lakhs. Now these two assets will be there with the shareholder. Can I say the shareholder, the asset which was received by the shareholder on the liquidation is also a capital asset for the shareholder now? What if this asset the shareholder will sell in the future? Can the shareholder sell this asset in future? Then capital gain will be calculated at that time also. How that capital gain will be calculated? And at that time, what will be the cost of acquisition of this asset in the hands of shareholder? According to you, what should be the cost of acquisition of this asset in the hands of shareholder? How much percent? No. Entire 15 lakh fair market value, which is right now considered for the purpose of taxability. Don't you think out of this 15 lakh rupees, some amount is already taxed as your deemed dividend, and out of this 15 lakhs, some amount is already considered as your income to calculate your capital gain. So entire 15 lakhs, what did I say? Entire 15 lakh fair market value of this asset, which has already suffered tax in your hand. If you will not take this amount as the cost of the asset, no, what will happen, you know? This 15 lakh will be taxed for the second time. You cannot say that the asset is free of cost. Did you give any money to buy this asset? What was the actual cost? Zero. You got the asset on what? Liquidation. Usually for all the assets we take what? Actual cost only, no? As the cost of acquisition. If we take the actual cost as a cost of acquisition, what will happen? Actual cost is nil, sir. And if we take actual cost as nil, in future if this asset is sold for, example, this asset is sold for 21 lakhs. In future, this asset, the shareholder is selling for 21 lakhs. So capital gain will be calculated. Full value of consideration 21 lakhs minus transfer expense nil. Net consideration 21 lakh minus cost of acquisition. Sir, you only said no. For all asset we have to take what? Actual cost as cost of acquisition. And for this asset there was no actual cost incurred by the shareholder because shareholder received free of cost at the time of what? Liquidation. So actual cost was zero. So if actual cost was zero, so I will reduce 0. 21 lakh minus 0, capital gain will be 21 lakh. Bloody in that 21 lakh rupees, that 15 lakh rupees of fair market value of that asset, which was already considered for the purpose of taxability, which has already suffered tax in your hands, will be taxed for the second time. If you will not take that fair market value as your cost later on, what will happen? That same fair market value will be taxed for the second time when that asset will be sold as your capital gain. Understanding? So tell me, how much is the gain which should be taxed at that time? Only 6 lakhs. Only. And apply some logic. Apply some logic. Huh? Did the company give asset free of cost? Yes or no? What was the cost which you paid? 0. And when in future this asset you are selling, how much you are earning? So in layman term, you are earning how much? 21 lakh. But bloody out of that 21 lakh, 15 lakh of the fair market value which is already considered for the purpose of calculating your tax. Yes or no? Out of 15 lakh, some amount was already taxed under the head IFRS. Some amount out of 15 lakh was already considered as the full value of consideration for your shares. So out of that 21 lakh rupees of gain, 15 lakh rupees is already charged as your income. So how much income should be charged now? Only 6 lakh. But to do that, this 15 lakh should be taken as cost. But if you will take 0 at that time, what will happen? That 15 lakh which has already suffered tax earlier will be taxed for the second time when this asset will be sold later on. Understanding what I am trying to tell you? So, if Mr. Girish has later on transferred the asset which he received on liquidation from A Limited for rupees, already transferred the asset for rupees 21 lakhs, yes or no? Which he received on liquidation from A Limited, then compute what? Compute capital gain. Now let's say it was transferred on, Girish has transferred on, let's take one date, okay no? Girish has transferred on 2nd of February 2026. No, instead of 21 lakhs, let's take 16.5 lakhs. Only 16.5 lakhs. Because within 1 or 2 months, the value will not increase that much. Okay, no? So what was the fair market value as on the date of distribution? 15 lakhs. And within next 2 months, the value of the asset increased. On February 2, the value of the asset became 16.5 lakhs. At that time, Girish sold that asset also. So will Girish calculate the capital gain on transfer of that asset? Yes. Now that asset belongs to him. It is his capital asset. Now if he will transfer that asset, on transfer of that asset also, the capital gain will be calculated. Getting me what I am doing? Hello? I am making a practical example to make you understand the entire provision. So first of all, what happened? Company went for liquidation. On liquidation, the company gave cash and the company gave asset. Now that asset came in the hands of shareholder. That same asset which the shareholder received on liquidation is now the capital asset of the shareholder. Now in future, meaning in February 2026, he is receiving on 17th of January and in February 26, he is selling the same asset. For how much? 16.5 lakhs. So will he now calculate the capital gain? Yes. So how he will calculate the capital gain? Come on, tell me. Simple, simple. So at this time also, computation of what? Capital gain will happen for transfer of such asset which is received on liquidation. Yes or no? Transfer of such asset in the hands of Mr. Girish. Now tell me, this capital gain will be calculated in which year? This capital gain he will calculate in which year? The year in which he is transferring that asset. In which year he is transferring? Same year only. This year only he is transferring. This capital gain was also calculated in 25-26 because he surrendered the shares. Liquidation was happening in this year. And in this year, liquidation also happened. This gain is also taxed. And now, in that same year, whatever asset he has received on what? Liquidation, that same asset he is transferring in this same year. Now here what will happen? Tell me, what will be the full value of consideration? Selling price. At what price the asset was sold? 16.5 lakhs minus transfer expense. No transfer expense was incurred. Dash. What is the net consideration? 16.5 lakhs. And minus cost of acquisition, which we usually take. Actual cost, which is nothing but nil. Please don't take this. Please don't take this. The cost of acquisition will be 55 subsection 2 clause B. The fair market value of such asset as on date of distribution, which was already considered for the purpose of taxability ahead. Yes or no? That will be, that fair market value will now be taken as your cost of acquisition. So 55(2)(b) gives you the option to take this fair market value also as a cost. But this option is not available every time. This option is available only if the asset was acquired on liquidation. So for that asset also, you have the option to take the fair market value as your cost of acquisition. This is what 55(2)(b) talks. So 55(2)(b) talks about two things. If any capital asset was acquired prior to 1st April 2001, for that asset you can take actual cost also or fair market value as on 1st April 2001, whichever is higher. That option is also given under 55(2)(b). But 55(2)(b) gives you one more option. That if you are a shareholder, you received some asset on liquidation. Then, if you transfer that asset in the future, what cost of acquisition of this asset you can take? 55(2)(b) gives you the option that the fair market value of that asset as on the date of distribution, which is already considered for the purpose of taxability under section 46(2) and as your deemed dividend, yes or no, that amount will also be taken as, can also be taken as your cost of acquisition. So definitely, if I have already paid tax on that 15 lakhs under the head capital gain as well as IFOS, why would I take that amount? Why shouldn't I take that amount as my cost? Yes or no? So how much was that amount? 15 lakhs. So I will reduce 15 lakhs. And how much is the gain now? 1.5 lakhs. And by the way, this is short-term capital gain taxable at normal rates. Because this is not short-term gain covered by 111A. This is the short-term gain, which is not STT paid short-term gain on transfer of listed equity share. This is short-term gain on transfer of NES. Sir, why are you saying that this is a short-term gain, sir? Because, my dear friends, I checked the period of holding of this asset. Shareholder, did you get this asset? On what date? You got that asset on the date of distribution, 17th of January 2026. And when did you transfer this asset? You have transferred this asset on 2nd of February 2026. Based on this period of holding, it is less than or equal to 24 months. Hence the asset is short term. Hence the resulting gain is short term capital gain. Understood or not? Easy. Will you be able to solve questions like this? This is one of the most toughest question on 46 which you can solve. I've covered each and everything in that same question itself. Getting my point? So now let's come to section 46. 46. See, in my notes now, whatever discussion I'm making, exactly the same thing you are going to get in my notes. But sometimes it is possible that in my notes, the example which I have taken would have different numbers. Because at that time while making the notes, some different numbers were coming in my minds. Right now, while explaining this, some different numbers are coming. Only the numbers will be different in my example, in my notes. Yes or no? Otherwise, everything which I am telling you is there in the notes. You just have to read them once. Will you be able to do it? I know how much you are going to do. Section. Hey, now should I ask you one question? Wait. Company was in liquidation, no? Your company was in liquidation? All the outside liabilities paid? Whatever remains belongs to the shareholder? Given to the shareholder on liquidation? So the asset transferred, the asset on liquidation to the... This transfer is exempt. This transfer is exempt. Every transfer is not exempt for company in liquidation. To pay some outside liability, company did not have money. So company sold one asset. Company in liquidation. Transferring the asset. Earning money or not earning money? Earning money. From that money, the outside liabilities will be paid. Will this transaction be exempt transfer? Don't do it. I have specifically told you the transfer by the company to the shareholder on liquidation will be an exempt transfer. If that same company transfers the asset to someone else and gets the consideration for that, that transfer will not be exempt transfer. Be very careful, huh? So always the company in liquidation, the moment you will see company in liquidation, start jumping. Exempt transfer, exempt transfer. A question can be framed like this. A Limited is a company in liquidation. Okay, no? Transferred one asset to Mr. Mohan for a consideration of rupees 20 lakhs to pay off the outside liabilities. Mohan is a shareholder. No. Transfer is happening to some other person for a consideration, and this transfer is not happening on liquidation to the shareholder. Hence, this transfer will be taxable transfer. Company is earning 20 lakh rupees consideration. Based on this 20 lakh, the capital gain will be calculated and will be taxable in the hands of company. Only the transfer of a capital asset by such company to its shareholder on liquidation will be treated as exempt transfer under section 46(1). Understood? So company is in liquidation. Asset is transferred on liquidation to the shareholder. Such transfer is treated as exempt transfer in the hands of the, therefore no capital gain to be computed and taxed in the hands of such company. Read this note, IMP. If the asset is transferred by such company into any, then the transfer will not be exempt. Here the capital gain will be calculated also and will be taxable in the hands of company. Yes or no? Now the company is in liquidation, doing some distribution on liquidation to the, now think from the point of view of the shareholder. What the shareholder is getting? Cash. What is getting? Asset. So the fair market value of that asset received as on the date of distribution. So the date on which the asset will be given, the fair market value as on that date you are supposed to consider. Yes or no? So, and deliberately in the question, no, two fair market values will be given. The fair market value of this asset as on the date of liquidation will also be given, and the fair market value of this asset as on the date of distribution will also be given. If you take the fair market value as on the date of liquidation, gone. As a shareholder, you are receiving the asset. So the date on which you are receiving the asset, what is the fair market value? That will be treated as your benefit. Understanding? So this was 5 lakh, this was 15 lakhs. Do you remember? This was how much? 5 lakh. This was how much? 15 lakhs. So total distribution was happening 20 lakhs. Sir, out of that 20 lakhs, some amount was already considered as your deemed dividend. How much? Out of the total distribution to the extent of reserves, to the extent of accumulated profits as on the date of liquidation. As on the date of liquidation, whatever reserves are there, to that extent the distribution was already treated as your deemed dividend. We will consider this amount under the head IFOS as my deemed dividend. Yes or no? But whatever balance remains, no, will be considered under the head capital gains. This balance will be excess distribution over and above this 6 lakh rupees. That was how much? 14 lakhs. This will be deemed to be your full value of consideration for transferring your shares. Yes or no? Now, based on this, the capital gains would be computed and taxed in the hands of the shareholder for transfer of shares in the liquidating company. Now take this amount as your full value of consideration, calculate your capital gain of shares. Minus the cost of the shares, you will get the capital gain. Now that capital gain of the shares is short term or long term? Depends on the period of holding of the shares in the liquidating company. Yes or no? The period of holding of the shares will start from date of allotment or date of purchase of those shares. Yes or no? And it will end on date of surrender. Any period after the date of liquidation will not be included in the period of holding of those shares. So the period of holding of those shares should end on date of liquidation. Please remember this, very important. Okay. Now based on this period of holding, if you say that the shares are short term, then whatever cost of those shares was there, reduce that. Based on this period of holding, if you say that the shares are long term, then whatever balance amount will be there, whatever balance amount of gain will be there, will be long term gain without any indexation, because the date of liquidation is on or after 23rd July 2024, meaning transfer is taking place on or after 23rd July 2024. But what if the date of liquidation was prior to 23rd July 24, meaning the transfer of shares is happening prior to 23rd July 24, and if the shares are long term, you might have to do the indexation also. But this case will not come in the exam for you, don't worry about that. Okay, no? The date of liquidation they will always say in previous year 25-26, meaning the transfer is happening in 25-26 on or after 23rd July 2024. So cost of the shares without indexation you are supposed to reduce. Yes or no? But the resulting gain will be long term, because based on the period of holding you come to know that the shares are long term. Understood? Yes or no? Now what if the shares are Date of liquidation was prior to 23rd July. Sir, what if the date of liquidation was prior to 23rd July, meaning the transfer is made prior to 23rd July. Now the cost of the shares will have to be indexed. How will you index? Take the cost of acquisition multiplied by CII. CII of which year? Transfer year. In which year the transfer is taking place? Liquidation. So date of liquidation is the date of transfer, no? So the CII of year of liquidation, CII of year of transfer, CII of the year of liquidation, yes or no? Multiply, divided by CII of year of acquisition. But don't worry, this thing is not going to come. But if it comes, you know that. What if the liquidation takes place on or after 23rd July? And the shares are long term. No indexation, reduce the cost, that's it. And liquidation will happen in your previous year only, don't worry. 25, 26, meaning on or after 23rd July. So this part will come, no indexation. But resulting gain will be long term. Understanding? Now tell me, note, the assets received on, by the, when did you receive that asset? In my example, on the date of distribution. Yes or no? From that date, you start holding that asset. So holding period of that asset will start from date of distribution. Date of, so from the date of distribution, you start holding that asset. Till the date immediately preceding to date of transfer. What if you transfer that later on? 16.5 lakhs. Will you again calculate the capital gain for this asset also? Yes. Full value of consideration, amount received on transfer, 16.5 lakhs minus transfer expense, if any, net consideration minus cost of acquisition. What will be the cost of acquisition of this asset which you received on liquidation? Actual cost, no? 55 subsection 2 clause B gives you an option to take the fair market value as on the date of distribution, which was already considered for the purpose of taxability earlier. Yes or no? You can take that fair market value as the cost. Understood? Reduce that, you will get the capital gain. And period of holding of such asset will start from this date, will end on this date. Yes or no? I have already discussed. If the asset was a short-term capital asset, the resulting gain will be short-term gain. What if based on that period of holding that asset was long-term? Then long-term gain, but resulting gain will be long-term gain without indexation. If that asset is also transferred on or after 23rd July 24. But what if that asset was transferred prior to 23rd July 24 and the period of holding you saw the asset is long-term? Then you will have to do the indexation. So 15 lakh, which is your cost of acquisition. Now you will have to index it also. Multiplied by CII of year of transfer divided by CII of year of acquisition. When did you acquire? 17/1/2026. Yes or no? So date of acquisition, meaning the date of distribution. So the year in which it was distributed, in that year you acquired, divide the CII of that year. Understanding? But don't worry, this is not going to come, indexation and all. Okay, but if it is there, you have to index like this. Will you remember? Section 46 is done. Now coming to the next section. Again, this is a very important section. Huh? Now tell me, one simple thing I am going to ask you, okay? One example I will create. Sir, first of all, no example. First of all, one diagram I am drawing, okay? Understand, there is a domestic company. Which company? Am I talking about any company or domestic company? Please remember, whatever discussion is happening right now is applicable strictly for a domestic company. Okay, no? So if the domestic company has done the buyback, Okay, before I explain this domestic company thing, tell me one thing. Any company. Forget about domestic company right now. For 2 minutes, forget about domestic company. Think about any company. I am a company. You are my shareholder. You are my security holder. So you acquired my shares, you acquired my securities. When did you buy those shares or securities? For example, you bought those shares or securities in 2009-10. Hello, shareholder, security holder. When did you buy my shares or securities? 9-10. What was the cost? 1 lakh rupees. What was the cost? Understanding or not? Now, see, since you are my existing shareholder, since you are my existing security holder, yes or no? You are holding the shares, you are holding the securities of this company. Now the company wants to buy back those shares from you, buy back those securities from you. Will you give those shares or securities to me? Please give it back. Please. Request. But if I offer something, will you give it back? So how much you bought it for? How much you bought it for? And today the value of those shares, today the value of those securities is 3 lakhs. Is how much? I'm offering you 3 lakh. Please give the shares. Please give the securities. Why are you not giving? Please no, I'm offering you fair market value. Market value. Sir. Even if you are offering 3 lakh, which is market value, if we wanted to have this value, we would have sold this in the market only, no? We don't want to sell at this value. That is the reason why we are holding. Will you give it for 3,10,000? Please give now. Will you give it for 3,50,000? 4 lakhs? 5 lakhs? Now please. Okay, understanding? So whatever amount which I am offering you right now will not be equal to the market value, will be higher than that market value. So that you become greedy. Okay? I have acquired for 1 lakh. Today the market value is 3 lakhs. Company is doing the buyback. And as a result of that, the company is offering a higher amount. How much? 5 lakhs. Sell it. You gave that shares or securities back to me and you took 5 lakh rupees from me. Possible, not possible? Gain is happening. Even that gain on buyback will be taxable under the head capital gain. 46A. Which section? So 46A says that whenever a company does a buyback of its own shares, own securities, what the company does? The company will give a buyback price which will not be equal to cost. No, more than cost. Equal to the fair market value. No, even more than the fair market value. So as compared to the cost, is the shareholder getting more amount? More amount means, sir, he is getting more than fair market value also. Huge gain happening, sir. 1 lakh minus 3 lakh, 2 lakh? No, 1 lakh minus 5. So, sorry, reverse. 3 lakh minus 1 lakh, 2 lakh gain? No, 5 lakh minus 1 lakh, 4 lakh rupees of gain, sir. And that 4 lakh gain should be taxable under the head capital gain in the hands of shareholder. So to charge that gain in your hands, there is a section known as 46A. There is a section known as 46A says that if there is a gain, profit or gain on what? Buyback. So before writing this, I will write 46A for you. Okay, no? What section 46A says? 46A says that any profit or gain, profit and gain on what? On buyback. Buyback of shares or securities. That profit or gain will happen to whom? It will happen to the shareholder. It will happen to the security holder. Yes or no? So that profit or gain on buyback shall be taxable. Taxable in the hands of that shareholder or that security holder. This will be taxable under the head capital gains. And this will be taxable in which previous year? In previous year in which buyback is taking place. Buyback is done. Yes or no? So the year in which the buyback is done, in that year, whatever profit or gain arising will be taxable in your hands. This is section 46A. But to calculate this capital gain, to calculate this profit or gain on buyback, 46A says, what will be the full value of consideration? Come on, you tell me. the buyback price which you are receiving will be treated as your full value of consideration, yes or no? And based on that buyback price, your capital gain will be calculated. Understanding? This is the end of section 46A. 46A says that the amount of buyback price given by the company received by the shareholder will be taken as full value of consideration, and on that basis the profit and gain will be calculated and will be taxable in the hands of shareholder or security holder in the year in which the buyback is taking place. Done, sir? Done, sir? So what is the full value of consideration? Very important, huh? What is the full value of consideration? Which the company will give you. And based on that full value of consideration, you calculate your capital gain. Understood, no? Now, let me take my discussion ahead. 46A, whatever 46A says, you have to remember. Now, buyback price was 5 lakhs. The company was offering how much? 5 lakhs. You accepted 5 lakhs as a buyback price. That will be full value of consideration. Minus what? Transfer expense. Net consideration, 5 lakhs. Assuming that there was no transfer expense, net consideration will be 5 lakh. Minus cost of acquisition. What was the cost of acquisition in your hands of those shares or securities? 1 lakh. Yes or no? So 1 lakh you reduce. The capital gain will be there. Profit or gain will be there. And that profit or gain will be taxable in which year? In the year of buyback. If the buyback is taking place in 25-26, this gain will be taxable in 25-26. What will be the nature of this gain? Short term or long term? Depends on the period of holding of that shares or securities. When did you acquire? From that date, the period of holding will start. And it will end on date of buyback. But sir, buyback transfer, on buyback, transfer is taking place, sir. Because the shares or the securities will be taken by the company, what the company will make? What the company will do? Belpuri? The company will take back those shares, company will take back those securities and cancel them. The moment the shares and securities will be bought back and cancelled, extinguishment of right is there. And extinguishment of right is happening is nothing but transfer. Hence, the capital gain is taxable under section 46A. Understanding now? Now, which company I was talking about? Which company I was talking about? So I am a domestic company, huh? Sir, I am a domestic company. You are my security holder? No. I'm not talking about security holder. Specific. Be very specific. I'm not talking about security holder. I'm talking about shareholder. So you are my shareholder. Shareholder, what I will buy back from you? What I will buy back from you? So buyback of shares is taking place, sir. Shares. Who is doing that buyback? Domestic company. From whom? Okay. Sir, what type of shares are these? Equity. Can be preference also. Listed. Can be unlisted. Any type of shares. Whether listed, unlisted, yes or no, equity, preference, any type of shares, the company is doing the buyback. Which company is doing the buyback, sir? Domestic company. Okay. Domestic company is doing the buyback. Now on the buyback, what the company is going to give? What the company is going to give? Banana? Apple? What the company is going to give? BB price. BB price is buyback price. So the company is taking the shares. Company is taking the shares. Now the moment the company will take the shares, the company will cancel the shares. Extinguishment of right. It is a transfer by you. And for that transfer, what are you getting? Sir, this buyback price should be treated as your full value of consideration under section 46A, and based on that, the profit or gain will be calculated and will be taxable, yes or no? Wait now. Wait. Now, please listen to me very carefully, very carefully. Very important thing. Up to 30th September 2024. Last year. Up to 30th September 2024. What used to happen, This buyback price, okay, company is liable. Company was liable to pay tax on such buyback price at the rate of 23.296% under section 115 QA. So company will earn income. On the income earned by the company, company is going to pay the income tax. Yes or no? But additionally, what did I say? Additionally, the company will pay additional income tax on this income also, which is not company's income, which is your income. This is not company's income. This buyback price is given to you. This is your income. On your income, you are not liable. No. There was one section, 115 QA, which made the company liable to pay income tax on this amount. So company used to pay how much tax? 20% plus 12% surcharge plus 4% cess. All of them taken together, effective tax rate was 23.296%. So 20 plus 12 is 32. 32 plus 4 is 36. 36 lakhs you will get if you will calculate like this. 20 plus 12 plus 4. No. 12% of 20. Surcharge will be on the tax. So how much is the tax? 20. Hello. On that, if 12% surcharge is there, so that 12% will be 2.4. Add that 2.4. You will get 22.4. On that 22.4, it was 4%. If you will add all of them, you will get 23.296%. Yes or no? So that amount of tax the company used to pay, sir. Has the company paid tax on your buyback price? Has the company paid tax on your buyback price? So now you are also liable to pay tax on that buyback price, no? On one income, the government will take tax twice. The government will say, hello company, you also pay the tax on this income, and to the shareholder also. Shareholder, are you getting the income? No. On that income, you also paid the tax. On one income, if the tax has already been paid by the company under section 115 QA, now the shareholder should not be made liable to pay tax on that income. Yes or no? So there was one section. The shareholder, such buyback price, I am saying such buyback price was fully exempt under section 1034A for whom? For shareholder. Bloody the buyback price only, which is fully exempt for you. Can you take this buyback price as your full value of consideration under section 46A? The income which is exempt, you will take that income to calculate your capital gain. 10 slabs I will give you. If somebody asks you, who has taught you, don't take my name. I disown you. The income on which the company has already paid tax is fully exempt in your hands. Bloody your exempt income, will you take that income to calculate capital gains under 46A? Hence, what used to happen, this entire buyback price, what did I say? This entire buyback price which was exempt under section 1034A for the shareholder, hence 46A was not applicable, meaning no capital gain to be computed. Because the capital gain which has to be computed by taking one amount as full value of consideration, if that amount itself is exempt in your hands, why to calculate the capital gain? 46A capital gain was not calculated only. Why it was not calculated? Because the amount on the basis of which that gain has to be calculated, that amount itself is exempt in the hands of shareholder. So we will forget your income, buyback price, you forget the cost of your shares. Understanding? Meaning the entire gain will not be taxable, because on that buyback price the company is paying the tax. Understanding? Sure? This does not happen now. This used to happen till 30th September 2024. Now, on or after 1st October 2024, on or after 1st October 2024, what will happen, sir? Hashtag. And I am writing that below. Okay, no? So, on or after 1st of October 2024, now the domestic company is not liable. Earlier it was liable, but with effect from 1st October 2024. Right now the situation is this only. So if the buyback takes place in 25-26, you have to do this. Understanding? So with effect from 1st October 2024, domestic companies, you are not liable to pay what? Tax on what? On buyback price under section 115 QA. Why, sir? Why? Because this 115 QA is omitted. The government removed this 115 QA only. No 115 QA. So the company is not liable to pay tax. Sir, earlier the company was paying tax, hence the buyback price was exempt. Hence the buyback price was exempt, no? Now is the company paying tax? So should the buyback price be exempt? No. So now that same buyback price in the hands of the shareholder will be taxable. So now what will happen, sir? The exemption which was available under section 1034A, this exemption is also omitted. Bloody, we were giving you this exemption because the company was paying tax on that. Now if the company is not paying tax, this exemption will not be available. That means therefore buyback price is what? Is taxable for shareholders. So shareholder, now this buyback price is taxable for you. Now based on this buyback price, take this buyback price as full value of consideration under section 46A and reduce your cost of acquisition. You should get what? Capital gains. Yes or no? This should happen or this should not happen? What they did, you know, what they did? See, this buyback price which was supposed to be considered as your FVC, to calculate your capital gain under section 46. This buyback price with effect from 1st of October 2024 will be treated as deemed dividend as per the newly inserted clause 222 clause F. So we are not going to bring this buyback price under the head capital gain as your full value of no, not under the capital gain as full value of consideration. No, we are going to charge this buyback price under the head IFOS as your deemed dividend. Now, if the buyback price is already charged under the head IFOS as your deemed dividend, that buyback price again you will take under the head capital gains, no? To calculate your capital gains. So here 46A will apply, but the full value of consideration will now be taken as nil. Why? Because the entire full value of consideration, entire buyback price is already considered as your income under the head IFOS as your deemed dividend. We don't want to charge this amount under the head capital gains. Why? Because if under the head capital gains also it will be taxable in your hands. Hello shareholder, you are going to pay us how much tax? The tax applicable on the capital gains. Yes or no? And if it is long term, it can be maximum 12.5%. So it was more beneficial for us to charge this amount in the hands of company who was giving 20% tax. So if we had to charge this amount in your hands under the head capital gain, we are going to get less tax from you. We want to charge this amount at normal rates, which can go up to 30%, and which is possible only if we consider this as your normal income under the head IFOS. Hence we are considering this as your deemed dividend, so that we can charge tax at higher rates, which can go up to 30% also. Hence we are not charging it under the head capital gains. But wait. Will your capital gain be calculated? Yes, capital gain will be calculated under section 46A. But there you are going to take full value of consideration as nil, because the entire full value of consideration which was supposed to be taken there, buyback price, is now considered as your. So now it is considered as deemed dividend under the head IFOS, and from this the cost of acquisition of your shares cannot be reduced here. Cannot be reduced here. So sir, this is very bad. No sir. See sir, if this amount would have been charged under the head capital gain, I would have reduced the cost. So only the net amount would have been taxed in my hands. For example, 5 lakh. 5 lakh was your buyback price. 5 lakh was your buyback price. What they are saying? Entire 5 lakh. Entire 5 lakh will be treated as your deemed dividend under the head IFOS. And no cost of acquisition will be allowed as a deduction. Sir, for the shares which are going, the cost was 1 lakh. Yes or no? So at least give the deduction of that 1 lakh. No, why are you charging 5 lakh rupees? No. Under the IFOS, entire buyback price will be taxable as your deemed dividend. We want to charge tax on the entire amount under the head IFOS. Sir, this is wrong. This is very bad. No, this is not at all wrong. This is good. We want to charge tax on the entire buyback price, and we want to bring your tax up to 30% if possible. Yes or no? So, which means that 1 lakh rupees will not be allowed as a deduction? Yes, not allowed as a deduction under IFOS. To calculate your IFOS income, why would we allow cost of acquisition under the head IFOS? Do one thing. 46A will still be applicable for you. You calculate your capital gain under section 46A. But don't take the full value of consideration, any amount over there. Take it nil, because entire amount is already considered under IFOS, and the cost which was supposed to be allowed, as a deduction, you take it from here. This cost we are anyways going to allow you. So what was the cost? 1 lakh. So out of nil, if 1 lakh will be there, it will not result into gain, it will result into loss always now. How much loss? 1 lakh. How much income there? Net is, we are charging tax on 4 only. But very smartly, that 1 lakh no, which is now considered as your loss, will be set off against any income? No, only against capital gains. Because now that has become capital loss, either short term or long term. Any long term gain, any short term gain, against that only that loss can be adjusted. That loss cannot be adjusted against any other income. And by the way, that income which was supposed to be taxed under the head capital gains is now taxed as your normal income under the head IFOS as your dividend. Very shrewd. This is the power of a woman. Motherly figure, no? Mrs. Nirmala Sitaraman. See. So, sir, did you understand this? Any domestic company, any buying back shares from shareholder. Which type of shares? Any type of shares. Listed, unlisted, preference, equity. Any type of shares are bought back. So on the buyback of the share, transfer is taking place because there is an extinguishment. Yes or no? And I am talking about whatever is happening on or after 1st October 2024. So if this buyback is happening on or after 1st October 2024, if the buyback is happening on or after 1st October 2024, so on this buyback, whatever buyback price is given to the shareholder by the company, this buyback price, entire amount will be taxable as the income of the shareholder under the head IFOS as deemed dividend, as 222F. And out of that buyback price, which is considered as your deemed dividend, the cost of the shares will not be allowed as a deduction. Understanding? Entire buyback price without allowing the deduction of cost will be taxable under the head IFOS as deemed dividend at normal rates. Now since that buyback price is already taxed under the head IFOS, now this buyback price will not be again taken as full value of consideration. In the hands of shareholders, since the shares are transferred, extinguishment no. So capital gain under 46A will also be calculated. But to calculate that capital gain under section 46A, the buyback price which was supposed to be considered as full value of consideration, which is already taxed under the head IFOS as deemed dividend, hence this should not be taxed again. So full value of consideration should be taken as nil. Under section 46A, the full value of consideration should be taken as nil. And from that full value of consideration, to calculate the capital gain, take the deduction of cost of acquisition of those shares. Now whatever resulting amount will come under section 46A will not be a gain, it will always be a loss. It will always be a, and that loss can be a short-term loss, it can be a long-term loss. It will be decided on the period of holding of those shares. And the period of holding of those shares will start from date when the shareholder acquired it, and it will end on date of buyback. Yes or no? Based on that period of holding, it will be decided whether the loss after reducing cost of the shares from the FVC, which is nil, the loss will come, the loss will be short term or long term, will be decided on the basis of this period of holding. Yes or no? And this loss will be allowed as a set off only from capital gains, either short term gains or long term gains, as the case may be. If the loss is long term loss, then it will be allowed to be set off only against long term gains, not against any other income. Yes or no? And what if the loss is short term loss? Then it will be set off against short term gain as well as long term gain only, and not against any other incomes, because capital losses can be set off only against capital gains. It cannot be set off against other incomes. Yes or no? So now your loss they have restricted in that head only. And the gross income, the entire buyback price is taxed in your hands at normal rates, which can go to 30% also. And by the way, this loss will be set off in this year if you have capital gains. What if you don't have capital gains? Will be carried forward in the next year. Next year capital gain will be there, from there it will be set off. What if next year also capital gain is not there? Then next year, maximum 8 years carry forward. After 8 years this loss will also lapse. But if that entire amount would have come under the head capital gain, at least that 1 lakh would have been allowed while calculating the capital gain, which is injustice which he has done. Understanding? Sure. Now any other case. What did I say? Don't apply all this. Don't apply. For example, I am a domestic company. You are my security holder. Now you are not my, you are my security. You are holding any securities other than shares. Can I buy back? Can I buy back? Will I offer you buyback price? Full value of consideration. Based on that, calculate capital gain. 46A. Yes or no? I am any company other than domestic company. Can I buy back the shares? Can I buy back the securities? Will I offer buyback price? 46A will be applicable. Calculate capital gains. Will you remember this? 46A over. And now this same point is going to come in IFOS when I will be discussing dividends. At that time, I am going to discuss deemed dividends. In deemed dividends, 222F will come. I will not explain that time. Day after tomorrow only it is going to come. I will see how much you remember by that time. Will you remember? No. Okay. Bye. That's all for today. So we are through with the second part of the chapter. Second part is specific charge over. Tomorrow we'll try to scrap the entire chapter. As much as we can finish tomorrow itself. If some part will be remaining, that we are going to finish day after tomorrow. And day after tomorrow we are going to start and end IFOS. Okay? See you all tomorrow. Bye. Bye.